Firstly, before I start today's video on the subject of the government-backed business loan schemes, I just want to say thank you to all clients who've been emailing me over the last few weeks since the last video. It's very useful to hear how everybody is getting on, the issues that have been causing difficulty, because all of that information is very useful for me to then make further investigation and find out more of the information that we all need to know. Also, thank you for all of your wishes after I recovered from what may have been the virus at the end of March and the start of April. I'm fully recovered now and ready to give you some more information. So let's go. So, as I said, today's video is about the government-backed business loan schemes, and significantly, whether or not your business should be borrowing money at the moment. The big question will be that at a time of uncertainty, is having more debt a good idea? We'll be going through the schemes. I'll be looking at the key points that are important to be aware of when considering whether or not to actually apply for a loan in the first place. Try and help you understand why not all businesses will be accepted for a loan. Understanding why it might or might not be in the interests of a business to take out a business loan at this time. And towards the end, and this will be very important, particularly for limited company businesses, understanding the potential and significant tax risks of a company using business loan funds to enable the director or shareholders to meet their personal financial costs. A bit about us. Existing clients obviously know us already, but for any people who are watching this who are not currently clients of ours, we are chartered certified accountants based in South Croydon in Surrey, with clients across the UK. We were first set up in 1969, and I myself have been working in the practice since 1990. We specialise in small business and individual taxation and business advice, and we work closely with tried and trusted third-party specialist associates so that hopefully we can provide you with a broad network of professional services. We see ourselves as being part of our clients' teams. We want to understand their businesses and help them succeed. And right now, with the impact of the pandemic, there's never been a more important time for an accountant to be there for their clients. Our client's success is our success. If our clients fail, then we're going to fail, and we have no intention of failing. An accountant's role should go beyond just preparing accounts and tax returns. There is a duty of care, and never more so than now. To find out more about us, you can visit our website, www.thecwmpartnership.co.uk, which is here. To email us initially, go to inquiries@cwmpartnership.co.uk, and there's our address and our telephone number. So moving on now to the loan schemes. The government-backed schemes, which are, to be honest, unprecedented, particularly for small business. I have never seen anything like this, and we may, hopefully, to be honest, never see anything like this again. But in regard to how the government is supporting small business, then they're not giving us the money, but they're making the money available to us. And two of the main schemes now are via these loans. So first of all, we've got the Coronavirus Business Interruption Loan Scheme, otherwise known as CBILS. This is available for an initial 6-month period. Also, just announced are the bounce back loans. These are going to be available from the 4th of May 2020. This video has been recorded on the 3rd of May 2020. So I am giving you as much information as we know at the moment to enable clients from literally tomorrow morning, the 4th of May, to decide whether or not they may wish to apply. I can obviously accept no responsibility for any reliance that people may give to this video, and if you require specific advice for your own business, you would need to speak to us directly. Again, by following the link on the previous slide, it will take you to the government page explaining the scheme in more detail. First of all, I'm going to look at the CBILS scheme and the key points, which are that the scheme will cover loans up to £5 million. Possibility that there will be a minimum level for these loan applications depending on the interaction with the bounce back loans, which I'll come on to later. I think that banks will push businesses to go for the bounce back loan option first of all, for one very good reason, which is that the government will guarantee the bounce back loans up to 100%, reducing the risk to the bank, making it easier for the application to go through. But any lending required over and above the limit of the bounce back loans then comes back under CBILS. So this is still relevant even to the smallest businesses. It will cover term loans and asset finance for a period of up to 6 years, and it will cover overdrafts and invoice finance for up to a 3-year period. The government backs 80% of these loans to encourage the banks to lend, but the borrower, of course, remains liable to 100% of the loan. There will be no interest charges or fees for the first year, and there will be an option to defer capital repayments to match the payments to income. So if at this current time the business has no income and it takes 6 months for things to get back to any level of normal, then the repayment of the loans could also be deferred to match that period. It has been confirmed that there will be no personal guarantees required on these loans for up to £250,000. That's been more relevant to limited companies where the director or shareholder may be asked or would have been asked to give a personal guarantee up to a couple of weeks ago. But if the borrower is a self-employed business, it's not quite clear how that's going to work, and you'd need to speak to the bank to get more information. One point which is clear from the website is that the borrower's home cannot be taken as security, which gives peace of mind. These loans are available from any lender, but my personal view is you would probably want to speak to your own bank first of all. And if you didn't speak to your own bank first of all, then any other bank may have a certain level of suspicion as to why you haven't gone to your first bank to begin with. For example, have they turned you down? Is there a problem? So normally I would suggest to clients that they speak to their own bank to begin with. One reason for shopping around could be in regard to interest rates, because for these loans, I believe the interest rates could vary. And if your own bank is asking for quite an extortionate rate, that would be a good reason to go to another lender. So keep in mind that you can go to different lenders, but perhaps go to your own bank first. And then if you go to another bank, it could well be that you say you're going to them because your existing bank wanted too much in interest. A key criteria under the loan schemes is business viability. There is no guarantee that you will be lent the money. And the rules state that companies with losses or insolvency issues, as at the 31st of December 2019, may be declined a loan due to the business in difficulty criteria. So they're looking at this date of the 31st of December in order to separate those businesses that were in trouble anyway against those that have become in trading difficulty with cash flow because of the impact of the virus. The proposal to lend money must be seen as being viable under normal trading conditions. So if the virus had never happened and you as a business had gone to the bank wanting to borrow this money, would you have had good reasons for wanting to do so? Or would it have been therefore viable, and would they have lent you the money in those situations? If the answer is yes, then you would pass the test for that. You need to be able to justify the reason for why the business wants to borrow the money. And although I haven't tried this yet, I don't think it would work, that if you went and said, oh, I need this so I can pay my living costs, then that's not a business reason for needing to borrow the money. A business reason would be for cash flow, perhaps on the other side, as things start to recover. Customers may need some extended credit terms. Or you could have a situation where your cash flow has run dry. And just to finance work, you need that initial injection of cash to enable you to do the work, to get paid and make your profits later. The government's own website states, if you want to borrow £30,000 or more, you also need to confirm that your business wasn't classed as a business in difficulty on 31st of December. Now this, of course, reflects on the point I made at the top of this slide here. But the key is, it states if you want to borrow £30,000 or more. That is to suggest that perhaps if you don't want to borrow £30,000 or more, these criteria may not be quite so important as would otherwise have been the case. So if your business was in difficulty, don't take this rule as meaning you can't even apply. But be aware that if it's £30,000 or more, the indications are you will need to answer that question. The banks, of course, are going to want some information from you for these loans, because after all, they could be for a value up to £250,000, and they're not just going to do a transfer to your account and leave it at that. So for these CBILS applications, they will definitely want to see your latest finalised financial accounts. Depending on the age of those accounts, they might want up-to-date ones to be prepared. In addition to the last finalised accounts, they're also likely to ask for the latest management accounts. I'm dealing with an application at the moment where that's exactly what the bank are asking for. They also need details of any business assets, e.g. buildings, vehicles, plant and equipment. With the reason for that being it gives the bank security that if the business failed, then are there any assets which would be available to be sold later on and recover the balance of the loan. They'd also need to have details of any borrowings against those assets. So if your business owns a building and it has no mortgage, then of course you're a far better bet than a business that has no assets at all. You are required to explain to the bank why you need the money, and in particular, the impact of the coronavirus on your business. These loans are designed to help businesses that are struggling due to the virus. Therefore, it's a perfectly valid question to ask what has happened to your business because of the virus. These are government backed, so you have to have something on file to answer that that question and tick the box for the criteria under a CBILS loan compared to just having a normal loan. Also, you need to explain what the funds are going to be used for. And as I mentioned earlier, I think to say that it's just to cover the director's living costs is not necessarily going to be an answer which will satisfy them. Up to a week or so ago, the banks were also asking for financial forecasts and a full business plan. And this was causing a lot of extra work and time and delay in making the loan applications. And also was causing difficulty because sometimes the more information that the bank has, the more reasons can then arise to not lend the money as opposed to lending it. So one thing that has been dropped is now an automatic requirement for the forecasts and the business plan. This was done under government pressure, and about a week ago that dropped off of the list of automatic requirements. However, based on the loan application I'm dealing with at the moment, the bank have suggested that it could still be useful if there is some form of business plan to explain what's going to happen to the business next. So it's very much a case of having a balance in the way you present your information to the bank. And further information again of these can be found by visiting british-business-bank.co.uk. And that's the CBILS scheme. Then we move on to the bounce back loans, which were announced by the government over the last week and are a very interesting development. The key points of the bounce back loans scheme. These are 100% government guaranteed to encourage the banks to lend. Under the CBILS scheme, it's 80%, which means the bank is taking a risk with the 20%. Any risk is not good for a bank. So with the bounce back loans being 100% guaranteed by the government, that means there is no risk to the bank. I'm sure they're going to have to undertake a certain level of check to satisfy the bank, satisfy the government rather, that they haven't been negligent with the government's money, but it's far easier to get these than for a CBILS loan. The borrower remains liable to 100% of the money they are borrowing. Businesses can borrow between £2,000 and £50,000. So the amount of funding available is far less, but for the smallest of businesses, this should be sufficient. However, there is a cap, and the cap is that the loan cannot exceed 25% of the business's turnover. So if your business has a turnover of more than £200,000, you will not be able to borrow under the bounce back loan scheme more than £50,000. At the time of recording this, it has not yet been stated how the 25% of turnover will be arrived at. Will it be the last filed accounts? Will it be management accounts? Will they need evidence of this? At this point, we don't know, but that is the criteria. So if you know that your business, for example, is below the VAT threshold, maybe the last account shows £60,000, then don't expect to be able to borrow more than £15,000. There will be no interest or fees charged for the first 12 months and no repayments due for the first 12 months. Now for the very good bits. The interest rate for these loans is not being decided by individual banks. It has been capped by the government, with banks being told not to charge more than 2.5% a year. That is very cheap money. Under any circumstances, a business would look at that and would be interested in the potential of borrowing it. The cost of having this money is very, very low. The loan period can last up to a period of 6 years. Another thing which has been confirmed very recently is that the banks are no longer subject to the Consumer Credit Act for these loans when applications are made. Now that governs the information that a bank has to ask in order to justify that when they were granting the loan, they made sure from their own independent checks that the borrower could afford to repay the loan, and that is allowing the banks now to cut corners on their checks and speed up the whole process. Once the loan is approved, the funds should be in the business's account within 24 hours. Of course, not tried and tested yet, but that's what the government website is saying. However, there are still some tests, and one of the main ones remains the business in difficulty criteria. So again, it's phrased as being companies, but this would also relate potentially to individuals who are self-employed. So we'll look at businesses with losses or insolvency issues as at the 31st of December may be declined due to business in difficulty criteria. I think the self-employed would have an easier ride with this than a limited company, but the criteria has to be understood. The date of 31st of December once again allows the separation for businesses between those that are struggling in December and those that are struggling just because of the virus. Once again, the proposal has to be seen as being viable under normal trading conditions, and the business cannot apply for a bounce back loan if they already have a CBILS loan. So this is important. So if you've already applied for a CBILS loan and, for example, have borrowing of £100,000, you cannot now go to the bank on the 4th of May and say, oh, can we have a £50,000 bounce back loan as well, please? The borrowing in regard to the schemes is being seen as an amalgamation, and it's the total of the two which is the criteria you have to pass. So one difference though, if you get a bounce back loan first, and let's imagine that scenario again of a £60,000 turnover, so you can get a loan of £15,000 and you then need some more money. You can't qualify for more money under the bounce back scheme because of your turnover, but you would then look to convert your bounce back loan into a CBILS loan and have all the application on the basis on the earlier slides with accounts, etc., asking for a larger amount of money. And the websites indicate that at the moment you'll be able to convert a bounce back loan to a CBILS loan until the 4th of November 2020. And as I say, this is definitely going to be applying where the borrowing is more than 25% of turnover. Do appreciate though that a CBILS loan interest rate is going to be higher than the 2.5% on a bounce back loan. A business has to be able to show that it's been negatively impacted by the coronavirus. Bounce back loans information likely to be required by the lender. The government are saying that the application will be via a short and simple form. What the questions are going to be on that form, we do not know, but at a guess, if we go back to the previous slide, I believe there's probably going to be something asking a business to confirm that they weren't in difficulty at the 31st of December. And I also believe there'll be questions in regard to whether the business has been affected by the coronavirus. And as long as the business in difficulty box is not going to be ticked and the business can justify that they have suffered due to the coronavirus, then the loan should be available to them. There are, of course, some businesses that have benefited from the virus, and whilst they be few and far between, in theory, they're not going to be eligible to apply for these loans. So the expectation is the majority of applications will be a self-certification, so the bank and the government would take your word for it. There's likely to be the confirmation about the undertaking of the business being in difficulty. My questions would be, what if this was later discovered to be the case? So if you made the application suggesting that your business was solvent, and then later the bank discovered, or the government discovered, that your company was in fact insolvent at the end of December 2019, what will they do? Because that will counteract the self-certification you made when applying for the loan. Would a larger interest rate be charged? Would repayments be due immediately? At the moment, we don't know, but you have to proceed with caution. Self-certification does not mean you can make it up as you go along. There are no personal guarantees allowed on the bounce back loans. That, of course, will apply for companies where they won't be able to chase the directors or shareholders to repay in the event of company failure. And it's not clear, though, how this would apply for self-employed borrowers. But the one thing which is in the notes is that no recovery action can be taken over a borrower's home or main private vehicle. This is available to firms trading on the 1st of March. So for a business that had previously ceased, then the scheme is not available to be applied for. And further information can be found by following that link. In addition to the CBIL scheme and the bounce back scheme, there is another loan option which businesses might wish to look at, which is for startup companies. This is not a coronavirus impact measure, but would be useful for any new business which has started to trade within the last 24 months, particularly those that have been unable to secure finance from any other sources. The Startup Loan Scheme is part of the British Business Bank, and many of the main high street banks and smaller ones sign up to this Startup Loan Scheme option. It's a personal loan, so there is a personal liability, and the borrowing can be between £500 and £25,000. It's repayable between 1 and 5 years at an interest rate of 6%. When an application is made, they will look at the individual's credit history, personal affordability, and the viability of the business. And to make such a loan, a new business would have to prepare a business plan and cash flow forecast. Now, of course, businesses do not always just operate on one individual, and the loan scheme recognises that, and each owner or part owner of a business can make an application. And a business as a whole can then apply for up to £100,000. So if there were 4 owners, each could borrow £25,000 under this scheme to give the business £100,000. And again, here's the website for further information. So I've explained the loan options. The question then, and the title of this video, is should your business apply for the loan? Now, desperate times call for desperate measures, and right now I could fully understand why business owners would rush to try and get a bounce back loan as a scenario which solves every problem, but that is not necessarily the case. So the following are my observations, and I'll run through them now. Rule number 1, business loans are for business expenses. That is very important, particularly for companies. And on the next slide, I'm going to go into more detail about why that is the case. My second rule is that personal loans are for personal expenses. And right now, if you need this money not to build your business up, but just to put food on the table and cover your outgoings, then the personal loan option suits better and would have far less consequence on your tax position. My advice right now is to continue to keep personal costs as low as possible until work recommences. So you should be looking, as I said in the earlier video, at mortgage holidays, avoiding unnecessary expenditure. So don't pay for anything that you're going to regret later. And generally keep the belt tight. It could well be that things return to normal sooner than later for you, but we just don't know right now. And nobody wants to look back and think, I wish I hadn't spent that money, because once it's gone, it's gone. So if you do need to borrow, then my advice is, if it's for personal purposes, look for a personal loan. Taking out a business loan, particularly for companies to fund the owner's living costs, is a high-risk strategy. It doesn't mean you necessarily shouldn't look to use some of the business money to pay you, because if you're working for your company, you're entitled to still be paid for your work, but you have to understand the risks. Next rule, whatever you borrow will need to be paid back. If you're able to get a bounce back loan of £50,000, that may seem like very good news right now. But if you defer repaying in the first year, then on a 6-year cycle, you are going to be paying that whole £50,000 back over 5 years. Or in other words, £10,000 of capital a year, plus the interest. So your monthly repayments will be getting on towards £1,000 a month for 5 years. So don't rush to get as much as you can if you're going to spend it all. Pause for thought, take your time, think about it carefully. Now, why would a business want to borrow the £50,000 right now if it's not to fund the owner's living? Well, there are good reasons for doing it, particularly because for the bounce back loans, the interest rate is only 2.5%. And a lot of the pressures that I'm seeing with clients right now with more complicated businesses are those, for example, who have higher purchase commitments, equipment leasing commitments, and even overdrafts and other bank loans, where the interest rates may be substantially higher than 2.5%, or alternatively, the loan repayment period is reasonably short. Taking out a bounce back loan might allow you to refinance part of those debts and spread the cost over a longer period of time and effectively give you a 12-month payment holiday. So these are ways to ease the cash flow and reduce interest costs and keep any cash that you have got in your business in the business. Because remember, in any business, cash is king. This could give you cash flow for future work. So here I'm thinking you could borrow the maximum amount and put it to one side in a deposit account. Try not to spend it. You might think, well, I don't really need this money, but you never know. So if you're that way inclined and you can be strict with yourself, then it could be worth considering borrowing the maximum amount, putting it to one side. If in 12 months' time, when the repayments were going to have to start, you still got it there and didn't need it, then repay the loan or repay part of the loan. But right now, in any recovery, cash flow is vitally important. Your bank balances, once work recommences, may be lower than they were. You may need to fund material costs, wage costs, and borrowing this money will enable you to meet those costs. Perhaps you may wish to give your customers more generous payment terms to encourage them to come back to you. Again, having money from a loan such as this will allow you to finance that increased debtor cost, which you'd otherwise suffer. It would also enable you to perhaps secure supplier discounts for early payments. On the other side of this, in much the same way as I'm suggesting more generous payment terms for your customers, your suppliers may wish to do the same. If you've got cash in the bank, you might be able to take advantage of that. Equally, if you currently have outstanding creditors that are chasing you for money, then taking out a bounce back loan could help there, because you're not giving the company an extra liability. You're just swapping a liability which technically is due to be paid now with a liability that will be due to be repaid from month 13 through to, as a maximum, month 72. So you keep on the right side of your suppliers, who you're going to need once trading recommences, and just easing the cash flow pressures. The other points I put on here, but there would be many more. It's a last one standing opportunity. So if you run your business in such a way that you believe it's successful, then there's every reason to believe you're going to be successful in the future. The reasons why businesses would fail, even where they were successful in the past, is because they've run out of money. So this could well be a situation where once things return to normal, some of your previous competitors may not exist anymore. And by having cash in the bank and being ready to go, which is what the government wants and needs, then you could find that trading circumstances are much better on the other side of this than they were before. And now finally, I come on to the business loan risks for small company owners. And this relates to issues if a director, shareholder, uses the money that is borrowed on a business loan for personal purposes. And it is particularly relevant for businesses with historically lower profits, or businesses with historic levels of debt. So it'll be useful to look at how we normally take our money from a company. So most small company owners draw income as a combination of a low salary and high dividends, as there are perfectly good legal and widely used tax reasons for doing so. Dividends are paid from profits. This is a fundamental issue that has to be understood. If you're not making enough profit, then you cannot take it as a dividend. If you are taking money out of the business which didn't come from profits, but which came from a business loan, then it will have to be classified in one of two ways. The first way is to declare it, instead of a dividend, as a salary. But if you do that, you're going to incur a PAYE tax liability, you're going to incur employees' national insurance, and also significantly employers' national insurance, which could be at 13.8%. Add all those together, and that's the reason why for most companies, the director shareholders take their income instead as a combination of salary and dividends. So if we don't want to take that money, which couldn't be a dividend, and we don't want to take it as a salary, then what happens? Well, in that scenario, it will be shown as being a loan from the company to the director, and it can then become an overdrawn director's loan account, e.g. the company has lent you money. So what is the problem with that? Well, the problem is that if you do borrow money from your company and you do not repay it within 9 months of the year-end date, then a Section 455 tax charge results. So if your year-end was the 31st of May and you take out a bounce-back loan this month and you use £10,000 of that money to fund your personal costs, then at the end of May, it is perfectly possible, due to the current situation and the fact you may not have much in the way of reserves in your company and you're not making any profits at the moment, that that whole £10,000 will then become an overdrawn director's loan charge, subject to tax under Section 455 at, wait for it, 32.5%. If things aren't then put right within 9 months, which takes us through to the end of February, that 32.5% charge will crystallise and will become a debt. If that happens, then the way you should be looking at things now is to think, okay, well, out of that £10,000 of loan money, which I'm going to need for my personal expenditure, I better put £3,250 of it to one side. If that's appeals, then fine. If you do that, there is nothing wrong. And in the future, when the company returns to profits and strong reserves, then that loan will be seen in the accounts as being repaid. I won't go into the technicalities as to how that happens, but basically an extra dividend will be put through to clear it. And then in due course, HMRC would give the company the money back. But that can take a year or so to be refunded. Now, the key here is if you take out a loan and use it for personal purposes, this tax bill will be there. If you're happy to put 32.5% to one side to cover it, then fine. But what if you don't put the money to one side? Well, then you're going to have a big tax bill, which will give you a serious headache in a year or so's time. So proceed with care. There are times when taking a director's loan account is a perfectly legitimate strategy. And there's plenty of tax advice out there that suggests that it should be done at times. But I'm not so sure that now is the time to do it. And that goes right back to the start of this video when I explained that, in my view, business loans are for business expenses, personal loans are for personal expenses. The other risk is if the company goes into liquidation. Now, I've explained that these business loans will often not carry a personal guarantee. However, if on liquidation, a company director is found to have an overdrawn loan account at the point of liquidation, then the liquidator will insist that the director repays the balance of the overdrawn director loan account back to the company. The debt does not die with the company. So if you take out a bounce back loan and at the point of liquidation you had not taken out the money for your personal benefit, you would not have an overdrawn loan account. If you do not have an overdrawn loan account, the liquidator would not tell you to put money back into the company, and the bank would not come after you personally for that debt. But if you used a bounce back loan or a CWM loan, used it for personal purposes, had an overdrawn director's loan account as a result, and then went into liquidation, that debt will not die. The amount that you took will be your personal liability. You must proceed with care. It's essential to obtain advice at the moment in regard to any use of these funds, which are going to be used personally, and you may need to do so. Maybe no choice. You have to survive the period. That's perfectly understandable. But you must have your eyes open. And this is why I'm stressing it so much. Just be aware. I don't want to be giving clients shocks in a year or so's time. The above cannot apply to somebody that is self-employed for technical reasons, but there are still risks of personal insolvency if, as well as a coronavirus government-backed loan, there are other personal debts as well. So if you're somebody that's got lots of credit card debt, then your personal financial risk will still remain outside of the fact that these loans are available and potentially not personally repayable in a guaranteed sense. So that has covered the whole topic of the loans in great detail, but it was important for me to do so because if you're going to take out a loan of tens of thousands of pounds for your business in the coming weeks, then you have to do so with eyes open. These loans can be absolutely fantastic. And one of the main things here is the fact that the interest rate for the bounce back loans is only going to be 2.5%. As I said before, that is incredibly cheap money. And if you manage things properly, this gives your business a great opportunity on the other side. We don't want to be having higher purchase debts right now at high rates of interest, overdrafts at the highest, debts that have got to be repaid in the short term, because we know that the short term is going to be difficult. This gives you long-term cash flow at a very low interest rate, and it is well worth considering borrowing this money for your business. But remember the risks if you're going to use the money for personal purposes. Any further advice required, of course, feel free to get in touch with me. No problem at all. I'd always rather a client asks the question than not. Moving on to the general coronavirus advice, continue to protect yourself and others. I'm not bringing up the slide saying stay safe, stay at home. save the NHS and save lives, because I understand that for some clients you've still got to go to work. Instead, I'm giving you the link for the Health and Safety Executive, which has important advice as to how to stay safe in the workplace if you cannot work from home. And for today, I'm now going to leave you with a final slide, further information about us. If you're not currently a client and you wish to speak to us, then there are the details. This is the way that I like to conduct business with clients. It's not just about ticking boxes. It's about making sure that clients don't make mistakes that we later on have to say, if only. We need to be there with you as part of the team for your success and hopefully then our success. Thank you for watching.